Hello and welcome to Price Physics, the science and logic of price action. Excuse me. Over the next several minutes, I will share with you the origins of price physics, its history, and what it can do for your investment and asset management environment. And I'll share with you some information about myself, William Shamp, the creator and author. Now, I've been a market structure researcher and teacher, financial software developer, and pioneer in the field of financial data analytics for over 20 years. I've known throughout the technology as the founder and creator of the price momentum science, price physics. One of the first individuals to see the critical value in analyzing market data and the inventor of constant volume bar charting. I invented one of the only fully objective, logic-based algorithmic methods that is highly profitable in its reactive, not predictive environments. Likewise, I've taught classes on pure chart reading and construction to chart professionals, market professionals in over 14 countries. Some of these individuals have called me the financial market's best kept secret. I prefer just the teacher of financial tools. My goal is to re-educate the open-minded hedging and investment asset management communities as well as high-end investors by showing them that price action can be consistently reactive in nature while keeping risk matrix analysis to unheard lows. This environment has been noted forever as being strictly predictive in its nature, but we all know that you can't consistently predict anything. And to be able to react to market conditions on an ongoing basis, if possible, would be the best of all situations. Now, my background is in logic and problem solving. I was taught by one of the industry's brightest. His name's Harry Cooper. He was formerly of the Raytheon Corporation. To apply these skills and to management in industrial settings throughout my years in corporate America, I then fine-tuned and customized those skills to fit into the financial markets. Now, there's a reason quants never discovered these secrets. They were never given the luxury or the time necessary to prove any intense theories. My background is not in the markets. My background is in problem solving. And when my mentor gave me this task to try to solve this problem, for me it was like a dog with a bone. I saw the issues that were happening inside this environment because of my trading. And my training was telling me that there had to be a solution. You just had to deconstruct the entire environment, put it back together piece by piece, figure out where the problems were, and then fix those problems. And that's exactly what I did. Now, how does that relate to what the market teaches the average investor, the average, asset manager, hedger, anybody in this industry that has been born out of a predictive model? Well, let's go back to September 11th, 2001. Remember the news media and what they were telling us when the terrorist attack happened. After, it came out, everybody was stating that, anybody that was short the markets on 9/11 was going to be indicted. Well, for those of us that could read the market, we understood that 5 months before 9/11, this market started to create a longer-term top and was constantly failing to make new highs, dropping lower and lower and lower. Until finally 9/11, we had just a gap and an ultimate collapse. After 9/11, moving into the end of 2001 and in early 2002, the market tried to recover but failed to move past its 2001 high, creating longer-term tops and even more critically failing to break through those tops by very, very small margins. For those of us that can read charts and that can read this environment, we knew that this ultimate scenario here was going to produce even a further pullback in price, which is exactly what it did. After that pullback and after that ultimate collapse down into the end of 2002, the market created a bottom. We see here a dead bottom and then a confirming bottom, telling us that the market was ultimately now going to go back up to try to challenge these longer term tops for the first time in over 2 years, which is exactly what it did. We broke through the resistance area here on November 12th, and then finally creating a new top in March of 2005. From March of 2005 all the way in through the end of 2007, this recovery, that long-term recovery, was finally completed, the first leg, in October of 2007. But for those of us that can read not only just a chart, but a well-constructed, balanced chart, we can see where prices were breaking through resistance or tops and failing to make new lows. It was easy for us to see market direction and to be able to capitalize on this. Now, we see this happening because the way the market wants you to see what's happening from a technical standpoint in the market is in an environment that is skewed to failure. This is a crude oil chart, just a particular day. This is from a number of years ago, but it's typical as any day in the market. This is a report day on a Wednesday. We see how at the beginning of the day these vertical lines show midnight, the day before and the day at the end of the day. We see what happens in this market where price began and ended at almost the same price. But what occurred when the news report came out at 10 p.m. was the prices of crude dropped, bounced, and recovered. Now, if you were looking at this on a daily basis, you would see that it was basically a non-event from the beginning of the day to the end of the day. Now, I'm about to show you the exact same chart, but structured in what I have created called constant volume bars. And that's where every single bar on the chart is weighted the same. It contains the exact same number of contracts traded. And as you can see, price still begins and ends at the same area, but the flow of that price now becomes more methodical, more rhythmic, and easier to view, easier to see. And if it's easier to see, it's easier to take profit inside those moves. Understand that when you go to the doctor and you go to a lab to get testing done, you want your test to be done in a pure environment, untainted by any impurities. Why don't we want our charts that we're viewing the market to be constructed with the same precision? I do, but the industry doesn't care. The industry wants you to look at minute charts. They want you to look at anything that is not going to give you the ability to add structure to the way that you view the market. Price physics is an ongoing cyclic decision-making process where your ultimate success is based on your ability to make informed, appropriate choices that result in consistent and profitable successes. You see it, you read it, you profit. And by reading it, I mean just that. If you learn the English language or any other language, it doesn't make any difference whether you're reading a newspaper, a magazine, a novel, a novella, a street sign. Everything is the same. Everything you read, you can understand because you understand that language. I teach you to read a structured balance chart in the same way. If you can read a stock chart, you can read a commodity chart, you can read a currency chart, you can read a precious metal chart. They're all read the same way. There is absolutely no difference in the way that they're constructed so that you can read them identically. Now, in my home in the heartland in the Midwest, I live and work in one of the greatest natural financial incubators in the world, the farmlands. I mean, I've helped farmers and ranchers, not only in my area, but worldwide, to understand that reading and understanding the movement of grain, livestock, and energy prices throughout the year is no different than reading the movement in the equities, stocks, precious metals, currencies, or any traded market. Price movement is price movement. If you understand the simple physics, those matrix that show you the specifics of each environment, then you can profit from it. Farmers have to know when bottoms are setting in on the market because they don't want to lock in their prices at those points. They must be able to read when tops are setting in the market because those are the areas where they have to lock in their prices in order to survive to the next year. They have to be able to read these environments in order to make the necessary profit from year in to year out. Those same skills can be converted to an asset management environment, an investment environment, hedging environment, and you name it. And this is what price physics teaches you. Now, I'm going to show you charts. I'm going to show you stock charts, futures charts, ETFs. These are all constructed identically the same way. They have all the same, the strategy is executing the exact same trades on all of these charts. And the reason that you see the consistency in these charts is because they're all constructed identically. Stocks, here we see Activision Blizzard. You see the buy triggers, sell triggers. I'm primarily going to show you the buys because we're in a stock environment. I will show you how the strategy, the algorithm that I've created will show you the pullbacks as well. But here we see a buy that was executed toward mid-February this year and how that it's still active. Here we have Boeing, and Boeing executed toward the end of November a buy, and it is still active today. Here's Baxter International, executed a buy toward the end of January of this year and is still an active long position today. Coach triggered a buying opportunity back in early February, and it's still in its current long position. We also see that, here's a sell that was here, a small sell that was a loss, another sell here. We see both sides. The algorithm, because it's reactive in nature, inherently will produce trades, winning trades that are far, far, far larger than losing trades because there are specific stops set in place for each individual position that you enter. Here's Cognizant Tech Solutions, again triggering a buy in February, still active. Here's Microsoft triggering a buy last year, mid-October, that is still active. And these charts are all active as of Cinco de Mayo, May 5th. So these are all current positions that are still active. Here's Corning, again executed the end of December, and it's still active in a long position. Honeywell International that executed, in December of last year, that's still in a current long position. Texas Instruments executed in October that is still currently in a long position. And as I said, I will show you a current sell position as well. And why not better to use is Target, very appropriate. Target executed a sell position right toward the end of the year, and it is still currently showing short. Futures, no different than stocks. Here's soybean oil. These are the continuous feed contracts, not the individual months, and I will show you those in a minute. Soybean oil has executed a short sell right at the beginning of the year that is still active. Canadian dollar executed a short toward the end of April, which is still active. The NQ, the NASDAQ, triggered a buy in the beginning of April that is still active. The Aussie dollar triggered a sell in the beginning of April that is still active. Live cattle, love my live cattle. Executed a buy order at the beginning of April that is still active. Sell order in soybeans that executed in mid-March, which is still active. Now, these are the individual contract months. Energies, metals, all work perfectly at being able to trade individual contract months. And what's amazing about trading and investing in these contracts is that they can trade out many months or even years and still become active profit environments. This is November 2018 crude oil. It's triggered a sell order back in February, which is still active. And this is the November 2018 contract. There's a good possibility this oil hasn't even, been pulled out of the ground yet. December 2019 crude oil. Basically 2.5 years out, this futures contract is active. It triggered a sell in mid-March, which is still active. December 2022. This contract is over 5 years out. It triggered a sell in March, which is still active. And closer months, this is June 2017, which recently, beginning of the week, triggered a sell. December 2017 triggered a sell beginning of May. November 2018 in heating oil, another energy market. And you'll notice that some of these markets work together so that when buys or sells are triggering in one of these contract months, a lot of times that they will be duplicated in other contract months, which is a huge advantage for you, the asset manager, investment manager, hedge manager, or just individual investor, because that you can trade these in blocks or sectors and make great profit. This sell in heating oil executed beginning of the month. It's still active short. Here is the July contract, July silver in the same situation. July silver triggered the end of April. It's still short. This is July 18, a little over a year out in silver. It's triggered short. Now ETFs. ETFs to me are great because they act as sort of an in-between for futures and stocks. You can trade them like futures, but they are stock funds. Here we see gold shares, gold spiders, and you can see the consistency at which they trade. Nice profit vehicle. Here we see a buy that's executed in the spiders, the S&P 500 spider, which executed mid-October, beginning in November, which is still active. Here's the QQQ, the power shares. that executed about the same time with a buy which is still active. We have U.S. oil, which is an iShare, and it has executed beginning of May as a sell. We also have a buy that executed in the financial sector for the spiders. That executed the end of October, first part of November, and it is still an active buy. Now, some of you like faster environments. I particularly don't, but for those of you that do, I will show you some of what I call swing charts. These are done in my constant volume bar charts, but they are also a little faster. Each one of these individual vertical lines show a day. So this is the movement of that particular unit, or in this case an ETF over that one-day period. We had a buy execute on Thursday in the Dow Jones Real Estate iShare ETF, and it is still active going into Friday's close. Here's a sell that closed out on Friday morning, that started, there's Thursday, Wednesday, Tuesday. This trade started on Monday as a short, executed on Friday. Really nice profit vehicle here, and that was on the gold shares. Everyone's success is more of a function of common sense than genius. My job is to give you the tools necessary for you to confirm what you're seeing in these environments. Instead of predicting, I give you the tools that will allow you to react to specific occurrences, balanced occurrences, structured occurrences that are happening in the market on a day-to-day basis. Now, many individuals offer trading methods to the public. What I give you is the key to the simple physics behind how price moves, where price is moving, where is it coming from, where is it going, and how to view the perfect structure of price at any given moment of any given day. Everything I do is based in logic. And for those of you that understand the logic environment, if it's logical, it can be programmed. Logic is not based in variables. It's based in absolutes. Everything I do is based in an absolute. Every trade that executes on every chart is an absolute trade. It's not, well, I think, or, well, it may be this is what it looks like. No, it's an absolute. If this, then this. The data that I provide for my classes for price physics is probably one of the largest databases that you'll ever receive from any individual. It's 90 gig, and most of the stock, future, and ETF environments go back as far as 20 years. The reason I give you that data is so that you can confirm for yourself that the trades, the strategies that I give you were executing identically the same way 20 years ago as they are today. There is no degrading of any environment. While I never stop talking about the future of the technology, I treasure the early days because of the sheer basics and the structure of this, pure data environment. I'm one of the original big data guys. I credit my mentors, Einstein for the tools to understand cycles, Charles Dow for the foresight to apply those cycles inside of sectors, and a local researcher and physician, Dr. Joseph Kapp, with opening the door to give me the confidence and to combine all those parts into a comprehensive unit that allowed me to prove my theories, but more importantly, to teach them to you so that you can prove them to yourself. One of the things that I teach in my class is you never trust anybody with what they tell you. If they can impart with you information that you can verify on your own, then you win. But to blindly trust anybody is not a good thing. I provide classes. I teach asset management individuals. I teach investment traders. I teach people that do hedging. I teach people to have the confidence in their decision-making process with what they're doing on a day-to-day basis. It's a very leisurely way that I teach you to profit from this environment. And the little cartoon here pretty much says it all. You're overthinking this, Phil, because what I teach you is simple. Humans make things more complicated than they need to be, and this is why I created the strategy that will show you on each and every chart where your trades are executing, where you should buy, where you should sell, where you should exit, and where your stop should be placed at each and individual trade. I've been doing this for 20 years with great success in a lot of different environments. Allow me to show you what you are truly capable of and to give you the tools that you can take these profit vehicles and capitalize them on a day-to-day basis. Stop by PRICEPhysics.com. Ask about the upcoming classes. If you would like a private class with your group or organization to take your investments to the next level, give me a shout and we can talk. I appreciate your time today. Take care and have a wonderful day.